Hey guys, welcome back to my channel. I know I haven't posted a video for quite some time. I just want to thank everyone for their continuous support to this channel. I've been trying my best to respond to every comment as diligently as I can, but for some strange reason, I also noticed that some of the comments have been unintentionally marked as spam by YouTube. So if I do miss out on your comments, I sincerely apologize for that. Coming back to today's content, in one of the earlier videos I posted on diagonal spreads, I did receive quite a lot of questions in the comments section. So in today's video, I'll be addressing some of the questions in detail. So if you have not watched my earlier video on diagonal spreads, I would highly recommend you to watch that video first before watching today's video, so that at least you have a good understanding of what a diagonal spread trade is about. I've left a link to the diagonal spread video in the description below. And more importantly, for today's content, I will also be addressing one of the more popular questions in the comment section, which is whether there is a cheaper alternative to diagonal spreads. As you all know, diagonal spreads can be quite expensive to enter, so if you just started trading and have limited capital, this will be a big problem. So in today's video, I'll be sharing a strategy that is a cheaper alternative to diagonal spreads. I was using this strategy when I first started trading because of my small account, and even till today, I still use this strategy every now and then when the market conditions calls for it. So let's get started. So just a quick recap on the diagonal spread trade. So the diagonal spread is actually a two-legged option strategy. So the first leg actually involves buying a dip in the money call option. The second leg involves selling an out of the money call option with a nearer date to expiration. So once again, if you have not watched my diagonal spread video that I've posted earlier, I will highly recommend that you watch that video first to get an understanding of diagonal spread trades before watching this video. So the strategy that I'll be sharing with you today is pretty straightforward. It is a single leg option strategy that involves buying a dip out of the money call option. Before you jump to conclusions on how a single leg option can possibly be good enough to match the diagonal spread, I will be doing a deep dive on the Thinkorswim platform to explain in detail why this single leg option strategy can be a good alternative. So coming to the Thinkorswim platform, I'm just going to use the stock Microsoft MSFT to do a deep dive illustration. So if you look at the charts of Microsoft, you can see that the stock has actually corrected quite a bit. So from the highs of about 350 sometime in November last year, all the way down to yesterday's close of about 262. So that's about a 25% drop from the high, right? So the stock has actually corrected quite significantly over the last couple of months. And if I look at the candlestick pattern over here, I can see a bullish pin bar. So for illustration purposes, let's say I assume that, or I feel that moving forward from here, Microsoft is going to reverse and go back higher, and I want to be able to capture the upside. I need to enter an option strategy that allows me to capture the upside of Microsoft over the next 1 to 3 months. Okay, so the two strategies that I'll be illustrating today would be the diagonal spread, and the other one would be the buying a deep out of the money long call. So before I move over to the options chain, one thing that I want you to note is that from the charts alone, I do expect the next resistance level to be somewhere around the 275 level, 275, 276 level. You can see here that historically, this was originally the support level for Microsoft and it has been broken. And if you look over at the simple moving averages, the red line here represents the 200-day moving average, and the pink line here is the 50-day moving average. So I do expect some form of resistance at this 275, 276 level, and that's where I'm going to put my short call for my diagonal spread. So let's move over to the option chain. So this is the option chain of Microsoft. I'm going to start with the diagonal spread first. So if you recall, for the diagonal spread, it's actually a two-legged option strategy. So for the first leg, I will need to buy a deep in the money call option that has a delta of between 75 to 85, expiring between 3 to 6 months time. So if I look at option chain here, I will likely select the one on 19 August, okay, expiring in 85 days time. okay? And I scroll all the way down looking for delta 85 to 75, okay? So I will likely pick the one on strike price of 220, delta of 81, okay? I'm going to buy this and it's populated over here. And now for the second leg of the diagonal spread, I will need to sell a nearer dated call option. So I will sell the one that is on expiring on the 3rd of June, 8 days out. Okay, scroll all the way down. So if you recall, in when we were looking at the charts of Microsoft earlier, I did mention that I do expect some form of resistance somewhere between the 275 276 level for Microsoft, and that's going to be the strike price where I'm going to sell my short call. Okay, so there's a strike price of 275 277.5. So to be on the safe side, I'll just sell the 277.5. Okay, so if you look at the diagonal spread trade here is complete. So if I have to enter the diagonal spread trade, it will cost me $47.74. Okay, just a quick recap. My long call is expiring on 19 August, strike price of 220 with a delta of 81. And my short call is actually expiring on the 3rd of June, strike price of 277.5 and a delta of 12. So if I look at the overall net delta of this particular trade, it is actually 69. So how do I get the number? Basically taking the long call delta, which is 81, minus the short call delta of 12. So that's how I get a net delta of 69. Taking a step back, what does a net delta of 69 for this diagonal spread actually means? So a net delta of 69 means that for every dollar move in the underlying price of Microsoft, the price or value of my diagonal spread should increase by 69 cents. So if the price of the stock of Microsoft moves up by $1, my option value should move by 69 cents, assuming all other factors remain the same. So if I look at it from a cost per delta perspective, if I were to enter this diagonal spread trade, it actually cost me 69 cents to capture every delta move of the underlying. How did I get this number? It's basically taking the cost to enter the diagonal spread, which is $47.74, divided by the total net delta of 69. And the question here is, if I were to look at it from a cost per delta perspective, should I be going for trades that have a higher cost per delta or lower cost per delta? The answer is definitely to go for the trade with a lower cost per delta because it costs you much less capital to capture every delta move in the underlying. Remember, all of us have limited capital. End of the day, our goal is to maximize our return on investment on the limited amount of capital we have. So having a lower cost per delta, you essentially enter the trade with a lower opportunity cost because your remaining capital could be used to invest in other trades. So moving on to the other trade, which is buying a deep out of the money long call. Same thing here. If I were to go to, I'm going to select a contract that is probably expiring 3 to 6 months out. I will select the one that is expiring on the 19th of August. Okay. And now instead of a two-legged option, I'm just going to select a single leg. In this case, if I select a deep out of the money, just for illustration purposes, I'm going to select the delta 20 over here. Okay, I'm going to click on this. Okay, delta 20. So you can see here that for the single leg option, I'm buying a deep out of the money call option that is also expiring on the 19th of August, but with a strike price of 300 and a delta of 20. Okay, and the cost for me to enter this particular trade is $4.25, and the cost per delta of this long out of the money call will be 21 cents, which means that it will cost me 21 cents to capture every delta move of the underlying. How did I get this number? It's basically taking the cost to enter the out of the money call, which is $4.25, divided by the delta of 20. So if I were to compare the diagonal spread and a single out of the money call, the single out of the money call definitely gives me a better risk to reward ratio because it has a much lower cost per delta, which means I need to come up with a lower amount of upfront capital to capture every delta move in the underlying. The next question you might ask is, if that's the case, should I just enter the strike price that has the lowest delta as possible to get the lowest cost per delta? The answer is actually no, and there are two reasons for that. If you were to look at the option with a delta of 5, strike price of 335, the cost of the option itself would be around 65 cents, and the commissions required for the trade will start to form a huge portion of your cost. So instead of just entering a single contract for delta 20, you might need to enter 4 or 5 contracts for an option with a much lower delta. And also, keep in mind that the deeper out of the money the call option is, the less liquid the option contract, and you might have issues getting in or out of the trade itself. The second reason is because of the gamma. You would have noticed that for deeper out of the money options like delta 9 or delta 7, the gamma is actually lower, or in this case, 0. Just a quick recap of the definition of gamma. A gamma of 0.01 means that for every dollar move in the underlying price of Microsoft, the value of delta will increase by 0.01. So gamma is essentially the rate of change of delta per dollar move in the underlying price. And you will definitely want a higher gamma for your option so that the value of your option will increase at a much faster rate per dollar move in the underlying. The other thing that I like about the long out of the money call, especially if you have a small account, is that you have more control over the max loss for the trade. Because the long out of the money call is not as capital intensive, I can afford to lose the entire value of my long call. So what do I mean by that? Let's say I have an initial capital of $10,000, and for every trade that I enter, I'm willing to lose a maximum of $400, which is 4% of my total capital. So if I choose to go long on Microsoft, I can enter a deep out of the money call option, Delta 20, and it will cost me $425. So even if the price of Microsoft collapses the next day, I can afford to lose the entire value of the call and let it expire worthless on the last day and still stick to my max loss that I planned for this trade. But if I were to enter a diagonal spread instead, the trade itself will cost me $4,774, and there is no guarantee that I can keep my max loss at $400. Because if the price of Microsoft collapses significantly, there is a possibility that I cannot close the trade in time and lose more than the $400 which I initially planned for. So from this perspective, the long out of the money call actually gives me better control over my max loss for the trade, and at the same time still giving me a better cost per delta as compared to the diagonal spread. In the next section of this video, I'll be doing a side-by-side comparison of the pros and cons of these two strategies. So let's take a quick look at the P&L charts for both trades. So for the diagonal spread, my max loss for the trade is actually $4,774, and that is the cost for me to enter the diagonal spread trade. Thinkorswim will actually block this amount from my buying power, and my max gain for the diagonal spread is actually capped by my short call, and for this particular diagonal spread trade, my max gain is actually $976. So for the single long out of the money call option, my max loss for the trade is $425, okay, and the upside is uncapped, okay. So this is the difference between the diagonal spread and the single out of the money call option. Coming back to the slides, I'll be doing a side-by-side comparison of the pros and cons of the diagonal spread versus the out of the money call option. So remember, no single option strategy is perfect. There is always a trade-off. So it is very important to understand the strength and the weakness of each strategy so that you can choose the right one under different market conditions. So looking at the upfront capital, diagonal spreads definitely have a higher upfront capital to enter as compared to the out of money call, which essentially means a higher opportunity cost because you could have used your limited capital for other trades. And because of that, the deep out of the money call option also has a better risk to reward ratio as compared to the diagonal spread. If you recall in the Thinkorswim demo, the cost per delta of the out of money call is only 21 cents per delta as compared to the 69 cents per delta for the diagonal spread. And I will also mention that I like the out of the money call option because it has more control over the max loss. Because for the out of money call option, your max loss can be just the cost of the option itself, while for the diagonal spread, because it is extremely capital intensive, there is no guarantee you can exit the trade at your max loss if the price of the underlying were to collapse very quickly. For the time decay, the diagonal spread definitely has an advantage because of the nearer dated short call that you sold, which compensates for the time decay of the long call. But for the single out of the money call, you are essentially racing against time where theta is working against your favor. So coming to the amount of effort required to monitor the trade, diagonal spreads will definitely need a lot more attention because you will need to time and roll your short call regularly and correctly. But for the out of money call, it requires no intervention. From a profit-taking perspective, you will definitely be able to make money from the diagonal spread if the price of the underlying was to increase, or if the price was to move sideways because of the short call premiums that you have sold on a regular basis. But for the single out of the money call, you can only profit if the price increase of the underlying more than offsets the time decay of the option. And if prices were to rally significantly, unfortunately for the diagonal spread, your upside is capped by the short call. But for the out of the money call option, your upside is uncapped. So to enter the trade, I usually select the option with a delta of 15 to 25. So remember, I mentioned earlier why I choose not to enter a much lower delta because of the cost of commissions and also the gamma. For me, delta 15 to 25 is usually the sweet spot. And also, I usually select the contract that is at least 3 to 6 months out. At least 3 months because I want to give the trade enough time to play out. There was a comment in my previous video on diagonal spreads on why did I not choose a much further out 1-year leap option. The reason is very simple. If I were to enter a call option that is 3 months out versus a call option that is 1 year out with both of them having the same delta, the time decay or theta difference between them is almost negligible. But the additional time premium you have to pay for the option contract that is 1 year out is significantly higher. You have a higher opportunity cost to enter the trade for the 1 year out option as compared to the 3-month out option, even though they have the exact same delta. Remember, this is all about the return on investment. How much upfront capital you need for the trade using the limited amount of capital you have. So typically for this strategy, I will start rolling the call when it has less than 1 month to expiration, and that's when your theta starts to increase significantly. And I will only roll this out of the money call provided that the uptrend for the stock is still intact and I want to continue to capture the upside. For the repairing of the deep out of the money call, there's actually nothing much you can do. If the price of the underlying crashed significantly and I still have 1 to 2 months of time left, I will usually do nothing and just let the trade play out. Unless there is a change in trend and the uptrend is no longer intact, in which I will exit the trade, which I will talk about in the next slide. When it comes to exiting the deep out of the money call, if prices rally significantly and you achieve the target ROI, you can always exit the trade for a sweet profit. And as I have mentioned earlier, if the uptrend is no longer intact and key support levels are broken, I will exit the trade even though I have not hit my max loss yet. And last but not least, if prices plunge significantly, I will usually just let the option run its course to expire worthless, and that usually is just the max loss I initially set out for the trade. So I'm perfectly okay with that. So that's all for today's video. Hopefully you have found this video useful. If you enjoyed watching this video, be sure to like and subscribe. If you're new to trading options, I would definitely recommend that you start paper trading with the Thinkorswim platform first, just to get yourself familiar. That's all I have for you today. Thanks for watching.